Welcome everybody, and in this lecture we'll discuss the most important topic in PGBP, and that is depreciation. Now in accounting you all study depreciation, right? What is depreciation? Depreciation is decrease in the value of the asset because of wear and tear. Now actually you don't pay the money, but it is shown as an expenditure in the P&L account. Correct? Same thing we'll do it while computing income under the PGBP header. Okay. So to compute the business income, depreciation is deducted. So did you pay? No. So can we deduct it? Yes. Why? Because there is actual decrease in value, right? That's why we can claim depreciation. So accounting, whatever we do, same thing we are doing in income tax also. But here the systems are different. Like example, in accounting, how you claim depreciation? You claim depreciation for each asset separately, correct? In accounting, you compute depreciation for each asset separately. But in income tax, depreciation is calculated not for each asset separately, but for a block of assets. So similar nature of assets, if which has similar rate of depreciation. What I said, similar nature of asset which has similar rate of depreciation, we call it as a block. And all that block of assets will calculate depreciation at a time. So this is the difference between accounting and income tax. So accounting, asset wise depreciation, each asset separately. In income tax, block, same nature, same rate assets put together, we create a block and calculate depreciation. In accounting, there are multiple methods of depreciation. You know that straight line method is there, WDV method is there, sinking fund method is there, annuity method is there, insurance policy method is there, labor hours rate is there, machine hours rate depreciation. So many methods are there. Double diminishing balance method is also there. So you calculate depreciation in accounting, lot of choices there, lot of options are there. You write which option you want to exercise in your accounting policy, follow that. That's it. But in income tax, there is no such choice. You have to calculate depreciation only on WDV basis, return down value basis. Or in accounting, we heard the word I forgot, diminishing balance method or reducing balance method, right? That method only we follow in income tax. So return down value method. Okay. So this is the significant difference in both. The third difference is the rate is not prescribed in accounting, right? For each asset, based on its life expectancy, you actually consider the rate, correct? But in case of your income tax, the rates are given in income tax itself. So you cannot calculate depreciation at whatever rate you feel. The rate is given in income tax, follow the same rate. In accounting, based on life expectancy, you decide the rate, right? But in income tax, rates are given, we have to just follow. So these are the differences. When learning, one wonderful habit is that whenever you try to learn something new, try to connect with something which you know. From there, you try to find something which is unknown to you. And that's the technique which I followed to explain you this. So suppose you are learning some new topic where I am not there with you. There also you follow the same technique, right? Known to unknown. This is some wonderful practice. Like suppose example, some cab you booked and you have to give directions. Now when you are giving directions to the driver, you cannot tell that come to this stop. He'll get confused. You ask him where he is. From there, because where he is, he knows. From there, you guide him to bring to your location. That's how a proper communicator will explain. And same thing I'm trying to do. You understood what you know in accounting, you compared with income tax. Now you understood income tax depreciation. Now let's go to the legal part. Section 32 talks about depreciation. Depreciation, to understand, I said in income tax, depreciation is given on the basis of block. Now, where the block is mentioned? In section 2, clause 11. Where it is mentioned? Section 2, clause 11. Now, two blocks are given. One is basically building, tangible assets, furniture, and plant and machinery. Building, furniture, plant, machinery. These are tangible assets. Similarly, know-how, patents, copyright, trademarks, license, or any other business or commercial rights is intangible assets. Like route permits are there. These are business and commercial rights only, but these are intangible. Are you able to understand? Okay. So this way you should be able to understand the difference. So block may be of tangible assets, may be of intangible assets. Tangible में कौन से आते हैं? Building, furniture, plant and machinery. Plant, even you can take machinery separate. Mostly they are together. Next, intangible में know-how, patent, copyright, trademark, license, right? Even sometimes we can say like route permits, I said, that also you can take, correct? Other business or commercial rights. But now, goodwill of business or profession, it is not at all a asset, right? We cannot claim depreciation on goodwill, right? Even though it is purchased goodwill, you cannot claim depreciation. So even though it is purchased goodwill, still you cannot claim depreciation. So no depreciation on purchased goodwill also. Please remember, okay? So goodwill of business and profession doesn't form part of block of assets. Now this is the definition part. But what is truly to be understood for solving the problems? Same nature, same rate. Then only we'll create a block for computing depreciation. What I said, same nature. Like example, furniture is there. All furnitures are treated as same nature. And for them, same rate, 10% is there. Similarly, all residential buildings come together. They create a block and all have same rate 5%. Similarly, all commercial buildings are one block. Whether it is showroom, factory, go down, they are all commercial buildings. So 10% is the rate. Now, furniture has 10%, building has 10%. Can you merge two and say we'll create a block? No, because rate may be same for commercial building and furniture, but the nature is not same. So nature and rate both match, then we create a block. Okay. Now, we understood what is block. But to claim depreciation, I always said, in accounting, you follow the nature. In income tax, we follow the rules. So there are conditions for claiming depreciation. What are that conditions? First condition, the assessee must be the owner of the asset. So to claim depreciation, the assessee must be the owner. So when we talk about owner, you should remember it's not only the registered owner. It can also be the deemed owner. Suppose example, I purchased a property. The property registration is done in my name. Then I am the owner because I am registered owner. Okay. Suppose example, I purchased a property and in my name the property is still not registered. But sale deed is executed. I got the possession also. So I got the possession. Sale deed is not executed. Oh, sorry. Sale deed is executed. I got the possession. But registration is still pending. So still I'll be treated as owner and I can claim depreciation. So whether you are registered owner, whether you are beneficial owner, both are considered. Okay. Second point. The asset must be used for business or profession. So there must be an asset. It must be owned by the assessee and it must be used for business and profession. If you satisfy these conditions, then under section 32 you can claim depreciation. Now, depreciation is given on all assets, or I can say all fixed assets. Suppose there are a lot of expenditure, like salary is there, rental expenditure is there, right? You can think about printing and stationery expenditure. Will you claim depreciation on that? The answer is no. You will claim depreciation only on fixed assets. That's what you do in accounting. In accounting, we write fixed assets. In income tax, we only use the word assets. But still, we claim depreciation on that capital assets, fixed assets only. Okay. Now, land is also a capital asset. But can we claim depreciation? The answer is no. Why? Because when it comes to land, there is continuous appreciation in the rate. The value increases. It doesn't decrease. So that's why land is an appreciable asset. So no depreciation. Right? We understood block. We understood conditions for claiming depreciation. So what is block? Block is given under section 2 clause 11. It may be building, it may be furniture, it can be plant or machinery. It can be intangible assets like know-how, patent, copyright, trademark, license, or any other business or commercial right. But not goodwill of business or profession. Goodwill of business or profession is not an asset, no depreciation on it. We discussed this. Then we discussed conditions. The assessee must be the owner of the asset to claim depreciation, and the asset must be used for business or profession. But please remember, we cannot claim depreciation on land because land is an appreciable asset. Some special points are there which you all should know. First point, beneficial owner, which I just discussed. Okay. Second point, if you are suppose a lease agreement is there. Now, there is a lessor who is the owner, I can say, and there is somebody called as lessee. I can use the word tenant for it. Okay. Now, tenant, that is lessee, will claim lease rent as his deduction while computing income under Income Tax Act. Correct? So, depreciation can be claimed by the lessor only. So, in income tax, lessor will claim the depreciation. Even though it may be financial lease, even though it may be a long-term lease, still the lessor only will claim the depreciation. Okay. Now come to hire purchase. In case of hire purchase, who can claim depreciation? The purchaser is the owner, correct? Of course, yaar, agar if you go with law, you will say only on the payment of the last installment, the purchaser will become the owner, correct? We discuss. But when he signed the agreement, his intention is to pay all the installments, correct? So we consider him to be beneficial owner. And that's why hire purchaser can claim depreciation. Of course, he don't pay any installment. The vehicle will be taken back by the seller. Okay. In that case, he will not claim. But in case of hire purchase, generally hire purchaser will claim the depreciation. In case of lease, the lessor will claim the depreciation. Suppose example, I am a part owner. Like example, 3 of my friends together purchased a building. Around 30 floors building we purchased. 10 floors me, 10 floors my friend, 10 floors his friend. Anyhow, all of us. Right? Now, can I claim depreciation for entire 30 floors? I'm not the complete owner, correct? I'm only owner for the 30%. So only for that 30% of the building cost, I can claim depreciation. Okay? Please remember. Dekho, depreciation is claimed for building cost, not for the cost of land. Suppose I purchased the land for suppose 20 crores and I spent 30 crores to construct the building. So that 30 crores I can claim depreciation. But this 20 crores is cost of land, no depreciation. Please remember this point. Okay. Now, on the cost of the building, we 3 can claim depreciation on the basis of percentage ownership held. Clear to all of you? Now, there may be some assets which are not like a normal asset. Like normal assets we regularly use in the business. correct? Plant and machinery, we use every day. But there are certain assets, like example, generator. Let's assume inverter. Let's assume that when we purchase a car, a stepney tire is set up, right? These are called as standby equipment. These are called as what? Standby equipment. You cannot claim depreciation on standby equipment because you don't use it. This argument is absolutely wrong. For standby equipment, the rule is it ready for use? If it is ready for use, itself is a criteria you can claim depreciation. Sometimes throughout the year, the electricity connection was properly functioning. So we did not use the generator. So it doesn't mean that you will not get depreciation on generator. You can claim depreciation because it is ready to use. That's it. So on standby equipment, if it is ready to use, you claim the depreciation. Okay, very good. Now, I'll tell you one thing. If an asset is partly used for personal and partly used for business. Suppose example, in my residential building itself, I have my YouTube studio. Now, YouTube studio is used for business and balance portions of house I am using for my residence. Now tell me, part of the asset is used for business and part of the asset is used for personal. Tell me what to do. In that case, that part which is used for business, only for that portion you claim depreciation. I'll tell you, suppose a building has suppose 3 floors. 2 floors are used for residence and 1 floor is used for business, correct? 2 floors for residence, 1 floor for business. Now what will we do? So 1/3 of the building cost, we can show it as asset in our income tax records, and on that we can claim depreciation. Okay. So whatever asset is used for business portion, to that extent we can claim depreciation. We'll discuss it under section 38. It will come later on. Section 38 says if an asset is used partly for business, partly for personal, only for the business portion you claim any deduction of expenditure, whether it is depreciation or other expenditure. Okay. For personal portion, you cannot claim any deduction or depreciation. That's how they explain the entire concept. Okay. And depreciation is a mandatory deduction. Please remember, depreciation is a mandatory deduction. Mandatory means compulsorily deduction should be claimed. Suppose example, you don't want to deduct, it's your personal problem. But when income tax department counts, they'll calculate depreciation every year. Actually, many people in the past had lot of deductions, and because of that, their taxes were zero. So they thought we'll claim depreciation later on. But income tax department said no. You have to claim depreciation every year. It's not a choice that this year I'll claim, that year I'll not. Every year you are supposed to mandatorily claim depreciation. Regarding rent, one point is there. You can see 7th point. I'll modify it and explain to you, right? And when you get the notes also, you'll have a modified version. Okay. Remember that rent of any building is taxed under house property chapter. In the past, there were so many things, but now rent of house property, whether owned by business, whether owned by a contractor, if he is renting it and getting rental income, let it be taxed under house property chapter only. That's it. Okay. Now, how to calculate depreciation for undertakings other than power generating units is the big question. Okay. Other than power generating units, you have to calculate depreciation on the written down value method. So as I already said to you, we calculate depreciation under income tax on WDV basis. That's what here we discussed. Okay. Now, in the first year of purchase, actual cost itself will be treated as WDV because there is no other data, correct? So actual cost itself will be treated as WDV, and on the actual cost we'll claim depreciation. But from the second year onwards, what will happen? We'll deduct depreciation from actual cost. Then we'll get the WDV for second year. Similarly, WDV for third year, fourth year. So WDV is available every year. So we'll take opening WDV on the first day of the previous year. Then we'll do additions. So most of the times it is purchase. Okay. So we'll add additions, that is purchases. And from that we'll deduct sales. Right? Any type of sale, any way, if the asset is going out, that will be deducted here. And finally, we get the closing WDV. From that closing WDV, we'll deduct depreciation so that we can get WDV for the next year. Because ultimately, how you should learn any topic. Like a small kid, if you actually think of remembering the topic, as we go older, our memory loss, right? As long as we are small, we are kiddie, we will remember so many things, correct? So you have to remember like a kid. You have to say opening WDV, add purchases minus sales, we'll get closing WDV. And from that closing WDV minus depreciation, we'll get opening WDV for next year. Like that, if you try to act like a kid, try to remember the topic, then you'll easily remember the topic. And when you shout it loud when you study, the chances of memorizing increases. Hey, it's not just teaching income tax, correct? I have to also help you to remember the things, and I do. Let's go to the next part. Now you understood how to calculate depreciation in case of other than power generating units. How to calculate on the WDV. In the first year, what will happen? On the actual cost, we calculate depreciation. Correct. In from second year, subsequent years, opening WDV plus purchases minus sales, we get closing WDV. On that, we calculate depreciation and we get opening WDV for next year. This is how you should remember the topic. Okay. Now I want to tell you that we got this. But there are certain important things, like some significant things, like significance of purchase. Suppose you purchased an asset in the current year and you put to use that asset for less than 180 days. Hey, I said two conditions should be satisfied. What are they? You purchased the asset in the current year and then you put to use the asset for less than 180 days. Then we should remember that you can claim only half depreciation. Like I tell you, for furniture, I said 10% is the rate of depreciation, correct? So, furniture is purchased on Jan 1st, 2025. Now, your previous year, everybody knows, correct? 2024 to 25. 1 year. From 1st April 2024 to 31st March 2025 is your previous year. And when you purchase the asset, 1st Jan 2025. Right? So now 90 days only the asset is used. Suppose you purchase the asset for 1 lakh rupees. Now, generally 10% depreciation. Correct? 10,000 is the amount of depreciation. 1 lakh into 10%, 10,000. But in the year of purchase, because you used the asset for less than 180 days, then you will only get half depreciation. So will you get 10,000 depreciation? No. You will get 10,000 into 1 by 2, only 5,000 depreciation. Now this rule is only for the first year, that too only the year of purchase. I'll tell you one more thing. Suppose you purchased the asset on 1st July 2024, right? And you put to use the asset on 1st Jan 2025. So when we count the 180 days, we should check from the date of purchase or from the date of put to use. What should be considered? So the right answer is condition says that the year should be the year of purchase. So the condition is met. Second condition is the asset should be put to use for less than 180 days. So what happened here? We should check the number of days of use from the date of usage. So suppose January to March. Suppose 90 days. That's it. So when we count for 180 days, we should start from the date of putting to use. Right? Okay. Second thing I'll tell you. Suppose example, if the asset is not at all used, then what to do? If the asset is not at all used, then don't claim any depreciation. No depreciation at all. Correct? Suppose if the asset is used in the year of purchase for 180 days or more, then claim full depreciation. Like I said, 1 lakh asset is there, 10% is the depreciation rate for furniture, then claim 10,000 depreciation. So if in the year of purchase you put to use the asset for 180 days or more, claim full depreciation, whatever is rate given. If you put to use for less than 180 days, but you put to use, then claim half depreciation. But in the year of purchase, if you did not put to use, then don't claim depreciation. Sometimes what happens, you purchase the asset in 1 year, but in the next year the data is given and they say put to use for less than 180 days. Or when you calculate, you realize in the second year it is put to use for less than 180 days. The income tax says don't bother. Income tax says claim full depreciation. So this rule of 180 days is only for the year of purchase. For subsequent years, always claim full depreciation. Okay. Now, let me sum up for all of you. Significance of year of purchase. Asset is purchased in the current year. The answer is yes. Then how many days it is put to use? Check. If it is 180 days or more, claim full depreciation. Less than 180 days it is put to use, half depreciation. Not put to use, don't claim depreciation. And in subsequent years, always claim full depreciation. But sir, if in the question they did not give the date of put to use, then believe that your date of purchase itself is your put to use date. So date of purchase itself is your date of putting the asset to use date. Okay. This way you should be able to interpret. Very small concept. Lot of content to remember. Correct. Now let's go to the rates of depreciation. Now very easy, very fast. We'll try to remember. Hey, I'm going to create this into 4 blocks. Okay. First block is building. Now tell me building 3 points only I have to remember. What are they? Hey, residential building 5%. Come on, repeat with me. Okay, when you repeat, you will remember. Residential building, rate kitna? 5%. Residential building, what is the rate? 5%. Commercial building, whether it is showroom, go down, right? Or an office, 10% is the rate. Commercial building, showroom, go down, office, right? 10% is the rate. Temporary structure, 40% is the rate of depreciation. So building, come on. Building is into 3 parts. What are they? Residential building, what is the rate? 5%. Commercial building, showroom, go down, factory, right? What is the rate? Office rate, 10%. Commercial building, 10%. Temporary structure, which is a building. Array, you want to construct a big building. Before that, you have to store some material for it, correct? So you create a small temporary structure. There you claim 40% depreciation. Okay. Now, furniture, very simple to remember. Direct 10%. That's it. Now, plant and machinery, there are huge content is there. So, I actually will divide plant and machinery into 2 different parts. Right? I'll show you the entire plant and machinery. Around 16 items are there on one screen. You can see now. Right? And I'll discuss 6 now, then 10. Okay? Let's remember. If suppose in the question they gave simple plant and machinery, so we should remember it is general plant and machinery. 15% rate will apply. Right? General plant and machinery, what is the rate? 15%. That's it, you should remember. But suppose if it is motor car other than on hire. Suppose example, Ambani purchased a car, Adani purchased a car. Now he is not going to start his taxi services, correct? It's for business purpose, maybe for personal purpose, correct? If it is for business purpose, not higher, then definitely 15% rate can be claimed, right? But if it is a motor car, if it is a van, if it is a bus, if it is a lorry for hire, then 30% rate of depreciation. So if it is a motor car, bus, lorry, what is the rate? 30% is the rate, right? So this way you should remember. If it is motor car, general rate 15%. Motor car, general rate 15%. Right? Motor car other than hire 15%. Motor car, bus, lorry for hire 30% is the rate you should remember. Now when you see CMA study material, you may find some more things I can also include. But necessary things we'll definitely remember. And unnecessary things we'll definitely ignore. That's what the funda when I prepared the notes. So come on, let's concentrate. So whatever is there that has been hand-picked for you specifically to discuss, which is unnecessary in today's context for previous year 24-25 is ignored. Because CMA don't delete the data which is not useful. And then it becomes huge for a student to study. But as a teacher, I have to make your job easy. Right. Come on. Let us remember what I said. General plant and machinery. If they give in the question plant and machinery, they don't tell rate, it is 15%. If they say motor car other than hire, 15%. Motor car, bus, lorry for hire, 30%. When they talk about books, books may be, books are books, yeah. Books by professional, books for businessman, books for annual publication, books for library. Any book, 40% is the rate of depreciation. Right? When I say book, it is 40% rate of depreciation. That's it, you should remember. Okay? Now let's go forward. We have to discuss about computers. Like computers, including computer software. Today, you are not just buying laptop, correct? In laptop with Windows, with MS Office, it is coming. So when I talk about computers, it comes with computers plus softwares, correct? And computers include not only computers, but also if you purchase some scanner, if you purchase some printer, it is also a part of computer itself. Your computer CPU, UPS, right? All that forms part of computer. What is the rate of depreciation? 40% you have to remember. Aeroplanes, aircrafts, helicopter, 40% is the rate of depreciation. Okay. When I talk about air pollution, water pollution control equipment, I say air pollution, water pollution control equipment. What is the rate? 40%. Okay. And when I talk about windmills, rate is 40%. That much you remember. What is old rate? What is before, you ignore. Okay. Windmill, the rate is 40%. That's it, you should remember. Okay. Life-saving medical equipment. I said life-saving medical equipment. Okay. Or suppose renewable energy equipment. So if it is life-saving medical equipment, renewable energy equipment, 40% is the rate for both. If it is oil wells, 15%. If it is ships, it is 20%. Are you able to remember? Ships, 20%, oil wells, 15%. And finally, if it is a semiconductor chip, a circuit, right? NVIDIA company you would have heard about. NVIDIA is very famous in making chips. Of course, yeah. Snapdragon is there, Qualcomm is there, Samsung is also doing in chip manufacturing. India, Vedanta started manufacturing chips, and many other companies are planning to. Because the future of technology is in chips, is in the software, is in the AI program, right? Recently in the budget, you would have heard that AI for education 500 crores are allocated. Why? Because government understands the importance of it. Okay, so semiconductor chips in circuits, how much? 30% is the rate of depreciation. Okay, this way all plant and machineries we covered. Now when you as a student remember, how will you remember? There are 10 items for which only 40% rate is there. 10 items, 40% rate. What are they? Like I said, 4 items are books only, right? Books for professional, books for businessmen, books for annual publications, and books for libraries. 40%. Simple. Aircraft, computer, air water pollution control equipment, and windmills. Again 40%. So 8 items over, right? Life-saving medical equipment and renewable energy equipment. Again 40%. So 10 items, this way you remember. Similarly, general plant and machinery is 15%, motor car other than hire is 15%, oil wells is 15%. These 315 rates you can come together and remember. Okay, very easy. Yes. Then you remember motor car, bus, lorry on hire, semiconductor chip. You will remember how much? 30% for both. And finally, ship is standalone. 20% is the rate. This way you should remember. And finally, come to intangible assets like patent, copyright, trademark, license, right? All these and other business or commercial rights. Like if I say franchisee agreements are there, exclusive dealership agreements are there. That is also an intangible right. And how much? 25% is the rate of depreciation. This way you should remember what are the different rates of depreciation, right? Now, let's continue. We have to discuss rates are clear. You are able to recollect. Very good. Now we have to discuss capital gains on depreciable asset. Now we know how to compute. Depreciation. Opening WDV plus purchases minus sales. Then we get something called as closing WDV. On that we calculate depreciation to get next year's opening WDV. Correct? But suppose we sell some asset in the block. Dekho, this whole opening WDV, add purchases minus sales, we get closing WDV minus depreciation, then we get opening WDV. All is not for a single asset. It is for a block of assets. Correct? And in the block, if you sell 1 or 2 assets, or maybe you sell entire block, then we should be able to calculate capital gain also. Correct? In accounting, we calculate profit loss for each asset. There it is easy because for each asset, what is the depreciation? We know. So we get the final WDV. And then what is the sale price? We compare. And then we say whether it is a profit or loss. We book it accordingly. But here income tax, we actually record all the assets in a block. Same nature, same rate assets, one block. So how to calculate capital gain? That is discussed here. Suppose you sold the entire block. No problem at all, correct? When you sell entire block, then there is no asset, right? So you may sell at more than WDV. That is, sale consideration is greater than WDV. Then what to do? So if sale consideration is greater than WDV, then it is short-term capital gain. Okay. Now, if sale consideration is less than WDV, then it is short-term capital loss. Please remember, you sold entire block. All assets in the block sold. Now sale consideration is more than WDV, greater than WDV, then it is short-term capital gain. If sale consideration is less than WDV, then it is short-term capital loss. Then it is short-term capital loss. That's how you should remember. Okay. So either this way or that way. Either gain or loss. because entire block is sold. So this way we did. But if suppose you sold part of the block, now some assets are out and some assets are still there in the block, then what to do? Then you have to see, is sale consideration greater than the WDV of the block? Sometimes you may sell it for more price, correct? So if sale consideration is more than the WDV, then in that case, you should understand that it is short-term capital gain. Sale consideration is greater than WDV, then it is short-term capital gain. But if suppose sale consideration is less than WDV, sale consideration is less than WDV, then what to do? Then let us imagine, let us try to understand. Please understand that there are still some assets. We can calculate depreciation on them, correct? So that's why we'll not treat it as loss. We'll believe that maybe the balance amount is for other blocks and let us claim depreciation. Okay, so I'm talking about if part block is sold. That means some assets sold, some assets still there. Even after that, if sale consideration is more than WDV, then obviously it is short-term capital gain. You got gain. And second one, if suppose sale consideration is less than WDV, still some assets are there. So we'll calculate depreciation in further years. In next years, we'll claim depreciation, no problem. This is how it is done. Now you may see whole content and ask me a question. The question is, sir, why short term, short term, short term? Because there is a section in capital gains chapter which says that if there is a capital asset which is depreciable, it will always be a short-term capital asset. So depreciable assets are always a short-term capital asset. So obviously the gain also will be short-term and the loss will also be short-term. Clear? Very good. Now let's come to additional depreciation. What is additional depreciation? We have to understand. So whatever I discussed till now, then what it is? If this is additional depreciation, then I'll call it as normal depreciation, and whatever we are discussing now, we'll call it as additional depreciation. So when we discussed about plant and machinery 15% rate, motor car, I discussed other than higher 15%, on higher 30%, that is normal depreciation. Okay, and now we'll discuss additional depreciation. So that means when we compute the income, we'll deduct less normal depreciation, less additional depreciation. The answer is absolutely yes. We'll deduct both. But in income tax, now there are two regimes, right? One is default tax regime, 115 BAC, and another one is optional tax regime, old regime, correct? So if you are filing return under default tax regime, that is under section 115 BAC, subsection 1A, in that case, you will not get additional depreciation. So can we deduct additional depreciation? No. Right? So if you are filing return under 115 BAC, you will deduct less normal depreciation. That's it. But suppose you are filing return under optional tax regime, old tax regime, regular tax regime, then you will say less normal depreciation, less additional depreciation. So this comparison you should be able to make. Okay. So in optional, you will get deduction for normal, additional both. And in default, only normal is deductible, additional no deduction. In 115 BAC, normal is deductible, additional no deduction. Okay, first point clear to all of you. Now, okay, under optional, we can claim deduction of additional depreciation, correct? in optional tax regime will claim the deduction of additional depreciation. But who can claim? The assessees who are into manufacture, production, processing, right? So if you are using plant and machinery for manufacture, production, processing, then only you can claim additional depreciation. Okay. So suppose example, I have a YouTube studio, I am recording classes, I have plant and machinery, and I want to claim additional depreciation. Income tax department say get out, no additional depreciation. Deloitte KPMG want to claim additional depreciation on their plant and machinery. Income tax department say get out, not allowed. But if suppose Reliance Industries want, Reliance Petrochemicals want, right? Adani Wilmar wants, then definitely additional depreciation is allowed because they are into manufacturing, they are in production, they are into processing, they will get. Suppose Adani Power, Reliance Power want to claim additional depreciation. Can they claim? The answer is yes, because second point support here. What is it? If the assessee is engaged in generation, transmission and distribution of power. If the assessee is engaged in generation, transmission, distribution of power, electricity, then definitely they can also claim additional depreciation. So if the assessee is actually purchasing plant and machinery and he is engaged in manufacture production process, or assessee is engaged in generation, plant generating, transmitting or distributing power, then definitely they can claim additional depreciation. But to claim additional depreciation, please understand. If you are into 115 BAC, forget about additional depreciation. Only if you are into optional tax regime, then only think about additional. If you are something like service industry, forget additional depreciation. If you are into manufacturing or electricity generation distribution, then think about additional depreciation. But for claiming additional depreciation, what are the conditions? First condition I said. Second condition, if the plant and machinery is purchased on or after 1st April 2005. That means on or after 1st April 2005. If you have purchased new plant and machinery, then you can claim. But please remember, if you have purchased the plant and machinery, which is basically a ship or an aircraft, which is a ship or an aircraft, no additional depreciation. So if you purchase a ship, if you have purchased aircraft, no additional depreciation. If you have purchased a ship, if you have purchased aircraft, no additional depreciation. Clear? Very good. Then I want to tell you that if you want to claim additional depreciation, the asset should be a new asset. If it is second-hand asset, no additional depreciation. If the asset has been already used, that means second-hand only, na? Right? The asset has already been used, whether in India or outside India. That means the asset is second-hand asset. No additional depreciation. Okay? If the asset is used, right, that means second-hand. No additional depreciation. Suppose if the asset is a residential dwelling, like you have put some ACs into your house, right? Laptop for personal purpose. Maybe laptops or computers in office also, right? Generator in office. For this, no additional depreciation. So additional depreciation is not available here. So whether it is residential, office or guest house assets, no additional depreciation. If it is road transport equipment, no additional depreciation. If it is an asset which is used for scientific research, then no additional depreciation. Because if the capital asset is used for scientific research, under section 35 I'll give 100% deduction, correct? So then why will I claim a penny 40% or 30% deduction? No. So under 35, I'll claim 100% deduction. Under 35 AD, if it is a cold chain facility, cross-country pipeline for petroleum, if it is inland container depot, if it is something like honey bee keeping, if it is infrastructure development project, right? There I'll get 100% deduction. If it is hospital with 100 beds, hotel with 2-star or more accommodation, there 100% deduction under 35 AD. So no additional depreciation here. Okay. So if you are claiming deduction under section 35 for scientific research or for specified business under 35 AD or under any other section, 100% deduction is claimed. Then no additional depreciation. This way you should be able to remember. So what we discussed that to claim additional depreciation, it should be manufacture, production, processing, or generation, distribution, transmission of electricity. But the asset should not be road transport vehicle, ships, aircraft. It should not be second-hand, already used asset. It should not be office, residential, guest house asset, right? And it should not be an asset where 100% deduction is already claimed. That is under section 35 or 35 AD. Then what is the rate of additional depreciation? 20% is the rate of additional depreciation. 20% on what? 20% on the actual cost of the asset. So is it given every year? The answer is no. Additional depreciation is given only one time. So there is a difference between normal and additional. Normal depreciation is given every year. Additional depreciation is given one time. Okay, that's it. Now, rate of additional depreciation is 20% of the cost. So when we should claim? In the year of purchase itself. Because it is one time, you claim additional depreciation in the year of purchase. Okay. But suppose in the year of purchase, you used the asset for less than 180 days. In the year of purchase, you use the asset for less than 180 days. Then you will get only half additional depreciation in the year of purchase. Like 20% is additional depreciation rate. Half means 10% you claim in the year of purchase. Next year you claim 10%, no problem. But only 20% is given in lifetime of the asset. That too in the year of purchase if the asset is used for 180 days or more. Otherwise 10% in the year of purchase, 10% in the subsequent year. That's it. And that too only on the actual cost. This way, if you remember, you will completely solve additional depreciation also properly. Okay, rate is clear to all of you. Now, some special points are there. Suppose you purchased the asset this year and sold the asset this year itself. Will you get additional depreciation? The answer is no. Or one hidden point I'll tell you. If you maintain the asset on the 31st March of the previous year, then only you will get normal depreciation, then only you will get additional depreciation. Okay? Right? Clear? If you maintain the asset on the 31st March of the previous year, then only you will get normal depreciation or additional depreciation. So if you sell in the same year, no additional depreciation. Correct? Very good. Now, suppose if it is a power generating unit. If it is a power generating unit. Power generating unit has only one power, that is they can actually claim depreciation on straight line or WDV. So suppose if power generating units claim depreciation on straight line basis, then no additional depreciation for them. So if power generating units want additional depreciation, they should ignore straight line method of depreciation and adopt the WDV. So power generating units have option to choose amongst the two. But if they adopt WDV, then they can claim normal and additional both. If they opt for straight line, they can claim normal depreciation but no additional depreciation. And in special note, first point I already said that when you compute your business income, you deduct normal depreciation and additional depreciation if you are filing return under optional tax regime. Right? If you are filing under 115 BSE, only normal depreciation. Similar to that, the first point says when you compute the WDV, right? In your business income computation, I said. Similarly, while computing the WDV, normal and additional both are deductible under optional tax regime. But under 115 BSE, only normal, no additional. This way you should remember all topics in relation to additional depreciation. Now let's go to power generating units. Now I already leaked the secret that only power generating units have the choice to decide whether they want to go for straight line method for depreciation or they want to go for WDV method for depreciation. But this option is there only for tangible assets. This option is there for tangible assets only. So if it is a tangible asset, they decide, but when they should decide? Before filing return. So when new asset is purchased, they'll file the return after that, correct? Every year they will file now. So before filing return or at the time of filing return, they should decide on this asset we want to follow WDV. Then in the lifetime of that asset, they should follow WDV only. If they decide they want to follow straight line, during lifetime of the asset, straight line only. This way power generating units have to do. But I said it is applicable only for tangible assets. Then what about intangible? Intangible assets, only WDV method. Okay, like all other entities are there, all other business organizations are there. They claim depreciation on WDV under income tax. Similarly, for intangible assets, depreciation is claimed on WDV method. Right? There is no choice. Choice is there only for tangible asset. Right? They follow straight line or WDV. And that too should be excised before filing return. And once excised, it will continue for lifetime. They cannot change. Okay? Very good. Now, suppose if they sell the asset, if power generating unit sell the asset, how income should be computed? Right? The answer is we'll take sale consideration minus WDV. We'll take sale consideration and we'll deduct WDV. We'll get some balance, na? Right? It may be negative or it may be positive. Correct? Suppose sale consideration is 1 crore and WDV is 1.5 crores. So obviously we'll say loss, 50 lakhs loss, right? 1.5 crore ka asset, 1.5 crore asset sold for 1 crore loss. So that loss is negative balance. And that is called as terminal depreciation. That is negative balance and we'll call it as terminal depreciation. And this terminal depreciation is deductible while computing business income. Okay, this terminal depreciation is deductible while computing depreciation. Sorry, business income. Okay, so suppose sale consideration is less than WDV, we say negative balance. Negative balance is loss. That loss is called terminal depreciation. It is deductible while computing business income. That's it. But suppose sale consideration is greater than WDV. Suppose sale consideration is 1 crore. WDV is suppose 60 lakhs. So 40 lakhs positive balance. What to do in that case? We should see that is sale consideration greater than, the balance is positive. But again further check that is sale consideration greater than original cost. If the answer is yes, suppose sale consideration is 1 crore, I said. WDV I said 60 lakhs. Okay. Original cost is suppose 80 lakhs. Okay. Now, so sale consideration 1 crore is greater than original cost of 80 lakhs. So in that case, sale consideration is greater than original cost, then sale consideration minus WDV, that is 1 crore minus WDV of 60 lakhs. 40 lakhs is your balancing charge. 40 lakhs is your balancing charge. Then this becomes your business income. So this will be treated as business income under section 41. I was telling you, you remember that there are two sections for income under PGBP, section 28 and section 41. Okay. So section 41 says this is balancing charge. It is income under section 41. Okay. So if suppose sale consideration minus WDV, the answer is positive. I said sale consideration 1 crore minus WDV 60 lakhs. So you got a positive balance of 40 lakhs. Then you compared with original cost. You understood that sale consideration is greater than original cost. In that case, you will say that sale consideration minus WDV, that is the 40 lakhs amount you got, is the balancing charge, your business income. But suppose, wait a minute. Yeah, let me explain to you once again. Okay, little confusion for all of you. So I'll have to just again repeat the things again. So just whatever I said regarding positive, just forget. Listen to me carefully again. Okay. So sale consideration is 1 crore. Then I said that WDV is 40 lakhs. No, WDV is 60 lakhs. Correct. Finally, we got some balance, that is 40 lakhs. Okay. Now in this case, is sale consideration greater than original cost? Suppose original cost is 1.5 crores. Now the example fits correctly. Okay. Sale consideration is 1 crore, WDV 60 lakhs, and the balance is 40 lakhs. When we checked original cost, it is 1.5 crores. So in that case, sale consideration is less than original cost. In that case, sale consideration minus WDV is equal to balancing charge, that is sale consideration 1 crore minus WDV 60 lakhs, balancing charge is 40 lakhs, that is your business income under section 41. Okay, this is clear. Now come to the second example which I gave, right? And I have to correct it. Same example I'll give so that you will understand the corrected version. I said original cost is 80 lakhs, right? So sale consideration is more than original cost also. Then we have to divide the income into two parts, right? So in that case, sale consideration minus original cost becomes your capital gain income. Sale consideration minus original cost becomes your capital gain income. So 1 crore sale consideration, 80 lakhs I said original cost. So 20 lakhs becomes your short-term capital gain. And original cost minus WDV, that is 80 lakhs minus 60 lakhs, again 20 lakhs come. That is your balancing charge, business income. Okay, this is what I had to explain. Now I feel you understood. Okay, write down properly the data, right? Sale consideration you write, original cost you write, WDV you write, right? If sale consideration minus WDV loss, then definitely terminal depreciation. If it is profit, then compare, is original cost greater than sale consideration or less than sale consideration? If original cost is more than sale consideration, then no problem at all. Correct? Simple. Sale consideration minus WDV, your balancing charge. But if original cost is less than sale consideration, then two components. Correct? What are they? One is short-term capital gain. How will we get? Sale consideration minus original cost. And one is balancing charge. How will we get? Original cost minus WTV. This way you should be able to compute the income. We'll solve the problems on paper with lot of numbers. You will get more confidence. The chart itself is super clear to all of you. Correct? Chal. We completed so many concepts in this video. Let us practice some more problems and we'll meet in the next video doing lot of problems to understand the concept. Okay? Bye bye everybody.